Good day, ladies and gentlemen, and welcome to our class on Introduction to Technical Analysis. Now, that's a big word and it scares a lot of people away. But basically, technical analysis is simply the study of price movements on charts. You could call it chart analysis. So we can think of technical analysis as sort of a framework that traders use to study and make use of price movements of a market. Now, technical analysis focuses exclusively on the study of price charts and trading history to determine the future price movement. So no matter what asset you're trading, no matter what style you're trading, you can know Google's going to go up. You could have some secret server information, okay? And you know Google's going to rise. But do you know what point to enter Google? Do you know where to put your stop loss? Do you know where to set your target? None of that can come from fundamental analysis. It's only going to come by price action and reading charts. Because you might think Google's going to go up, but your same buddy who shared that information with you has shared it with 1,000 other people, and those 1,000 other people already pushed up the price of Google higher than it should have been. Okay, so you need to look at a price chart to understand it. Plus, if I were to simply say to you, Google is now trading at 147.42 and it was at 147.44 this morning, and it was at 147.47 an hour ago, and then it was 142.29 at the close yesterday, and then midday yesterday was 147.44. Could you repeat any of that to me? Could you make any sense of it? But you sure can when you're looking at a chart. So as I said, I call technical analysis chart analysis. Technical analysis is anything you do on a price chart, from simply looking at a simple line chart to looking at complex indicators and all types of things. All of it is technical analysis. Now, a lot of people think that technical analysis is simply the addition of all of these mathematical calculations that we call oscillators and indicators. But that's only one small part of technical analysis. Now, technical analysts believe that all current market variables are already reflected in the price movement and price action. So if we believe that all market variables are reflected via price movement, it only goes to reason that we don't really need much else to analyze and trade the markets besides price. So I am basically a technical analysis who uses some fundamental analysis, but I don't even use any technical indicators. I don't use any, well, I take it back. I do use moving averages, and that is a mathematical calculation. But I don't use any of what we call indicators and oscillators. Okay. So most technical analysts believe that the idea that all market variables are reflected in price action, and I firmly believe, I am a price action trader, that everything is already in that price, and the only thing that can tell you anything is price. Now, you still need to be aware of the fundamentals in the news, because that can mess up your trading or create temporary volatility that can wipe out your entire trading scenario. So you shouldn't be 100% one and zero of the other. So technical analysts look for patterns on charts that tend to repeat themselves. They do this to develop their trading edge. The underlying logic here is that since price movement is driven by human beings, certain patterns will repeat themselves in the market, as human beings tend to be repetitive in their emotion and interaction with the market. Technical analysts also encompass learning to analyze the market structure, find trends, find support and resistance levels, and generally learn to read the ebbs and flows of the market. There's obviously discretion involved here, and I will be the first person to tell you that technical analysis is more of an art than a science. It's feeling what's happening. Now, that said, it is something you will get more comfortable with and better with given time and practice. Now, the way I try to explain it all is, if you believe, which I wholeheartedly believe, that price is ultimately random, is based on a whole bunch of human beings all over the world. And price is random. But there are certain times when price exhibits non-random tendencies. In these certain areas of time, we can then make sense of what's going on and apply all types of analysis to find a solid trade or understand where the markets are going. Now, these non-random elements of the market are what we refer to as trends. And the only place you're going to see a trend is on a chart. So most traders instantly think of a price chart anytime someone mentions technical analysis. Price charts provide us with an amazing amount of useful data that paints a complete picture of the market's historical and current supply and demand. Now, price charts are also a reflection of all market participants' beliefs about the market and market variables. So by focusing your analysis and trading on the market's price action, you can streamline your trading, and at the same time, your analysis and what you'll get is a better understanding of where price should be. And it doesn't have to be complex. Too many people put all these technical indicators and oscillators and lines and drawings and everything on their chart that you can get lost, absolutely lost. But you can also make it simplistic. A good trading strategy is just looking at support and resistance lines and trend lines, okay? And looking at price, or simply an indecision candle. Where does this candle happen to form in the movement of the candlesticks, or just by using candlesticks? Now, technical analysis is a method of predicting price movement and future market trends by studying charts. One major advantage of technical analysis is that experienced analysts can follow many markets and many instruments simultaneously. Now, there are 5 categories in technical analysis theory. One is reading price charts, like reading bar charts or reading candlestick charts. Then it's 2, understanding understanding trends and trend lines. 3 is interpreting price patterns. 4 is understanding indicators like oscillators, like RSI and MACD. And then last is number theory, like Fibonacci and Gann numbers and waves. And these are the 5 main sectors. Okay, all of us should be able to read price charts properly. Okay? And that is, if you can't read a chart. Now, this is not candlestick pattern recognition. This is if you can't look at a candlestick chart or a line chart or a bar chart and understand what it's saying, then you need to go back to school. And you can attend our class on learning charts. Then there's a big difference between trends and trend lines. Trend lines are rule-based and help us a great deal. Trends are like what we have in fashion. Skirts, dresses are going up, heels are going down, cars are going to mid-size. We're buying more blue cars than red cars. And again, this is where I said when prices and trends, they are the non-random part of the market. And then we have interpreting price action. These are price patterns like triangles, bars. Actually, let me pop a couple up on your chart for you. And I've got a chart set up for me. Okay, here's one of my basic charts. We see a triangle pattern on there. We see my resistance and my support zones. And this is it to make a whole entire trading decision and prediction. Then here we see another variable of it. But again, it's using support and resistance levels and reading candlesticks. So we see candlesticks go up above support. We see it bounce off. We see an indecision candle, and we see the markets reverse. Okay, this was reading price on a chart. And this is how part of technical analysis. Now when we talk about price patterns, okay, we look at things called triangles and wedges and head and shoulders. And these are actually known patterns that develop in trading all the time. And they're part of technical analysis. But when price develops, and we can make real complicated decisions. But as we see a triangle developing, we know as price is forced into the apex, it's going to have to do one or two things. It's going to break out, and it's going to either break up or break down. We can then be prepared for that break. Okay. So again, this is technical analysis, and this is interpreting price patterns. Okay. We can also go back and add under our charts little things like moving averages and moving average crossovers. We can add on things like volume, volume, which shows us how many buyers and sellers, or how many contracts are being, or how many assets, or how many shares are being traded of an asset. We can go from there and add on things like indicators like MACD, which is considered a technical indicator that goes on the bottom of your charts. So these are all different parts of technical analysis. They can help you interpret the market. You can use one of them, all of them, none of them. All those red and blue lines, those are my support and resistance levels. And we have whole classes in support and resistance strategy, understanding support and resistance, adding. We have a whole video on MACD. We have a whole video on the top 10 indicators. So there's lots of ways that you can learn this, but you can find a lot of this information right here on our channel at your convenience. So let's go back, talk a little bit more. So price charts are basically a pictorial price history. And its objective is to predict the future prices. Then it makes sense to focus on price movement. Price movement usually precedes fundamental developments. By focusing on price action, technicians are automatically focusing on the future. So understanding charts. We need to understand what they're trying to tell us, where the price has been, where the past and present volatility is, and what the historical volume or the trading level should be. They will assist us with entry points. Even when we've done all of our studies and decide we want to go into the market, we still have to figure out what price are we going to actually enter the market. Okay, what price do we say, okay, it's not reaching the price we want to enter the market, so we're not going to trade it. At what price do we want to get out of the market? Or if the market turns against us, how do we know that that is happening? Now, we have three basic kinds of charts. We have line charts, which are you can't trade with. They're just connecting dots together on the close of each asset. Then we have bar charts. These were the favorite and the standard. I combine bar. I go back and forth between bar and candlestick. But if you notice as we go forward, everything relies on the same four pieces of data: the open, the high, the low, and the close. So a bar chart, sometimes called an OHLC, you put a doohickey to the left at the open, a doohickey to the right at the close, a dot at the highest point it achieved in that time period, and a dot at the lowest. You draw the line together, and you have a bar. And these bars sometimes will show us commonality in prices over historic time. That commonality in price points becomes a support or resistance level depending on prices going up or prices going down when it approaches that price. Then candlesticks are the most popular in online trading. Although candlesticks have been around for hundreds of years and they were used by rice traders, they are an effective way in trading, and since we have all these new HTML charts, they've become the buzzword in online trading. Now, candlestick charts show the same information as a bar chart, but in a slightly different graphical format. So here we see a candlestick gives us the open, the high, the low, and the close. But then between the close and the open, we draw what we call the body of the candle, and those other two parts are called the wicks. And different size candles located next to each other tell us something about price. So candlestick charts are the most popular of all three major chart forms. But now that you can read your price charts, you need to put in the work. You need to put support and resistance on your charts. Now, not just to make your trade, any of the assets you're trading, because support and resistance hold true forever. So once you put these lines on chart, when price is at that level, they're important. But when price falls way below that level, they just are not important anymore. But when price moves back to that level again, they become important. So if you consider support and resistance like an elevator, and they're the floor below your feet and the ceiling above your head, well, you still need to reach floor number 10, even though you're on floor number 1. But the only thing you're concerned about is floor number 1 and 2 till you pass number 2. Okay, go number 3, number 4. When it comes back down and starts coming back down from 10, each of those numbers become important again. Now, there's many ways to find support and resistance. Some of us are support and resistance traders only. And then I mentioned before triangles. These are chart patterns. These are patterns that develop on your charts and tell us something about what is happening. We have triangles, we have wedges, we have head and shoulders. And these are not price patterns I've made up. There are a handful of well-known chart patterns that all of us trade with that have specific rules and that will help us understand what is happening in the market. So here we can see a symmetrical triangle. We see a rising wedge. We can see a bearish pennant. We can see an expanding triangle. Okay, these are all specific patterns that occur while price is moving. And when price develops this pattern, we can then predict our target point, our entry level, and our stop loss based on that formation. So we have double tops, double bottoms, head and shoulders, reverse head and shoulders, rising wedges and falling wedges, but only a handful. So to trade these chart patterns, simply place an order beyond the neckline and in the direction of the new trend. Then go for a target that's almost the same as the height of the formation. Not complicated. This standard formula works great. See, all of these, you look on the right, you can see the standard formula, and they work. They're reliable. You can test them on demo accounts and test them over and over. I am a triangle trader. Okay? I trade everything based on triangles, support and resistance, and moving averages. That's it. So you can make things as complicated as you want or as simple as you want. Or you can take just one field and but you can start learning just candlesticks and reading candlesticks. And that's where you could be. Okay? Once you've mastered that, you can add something on. You can keep adding things, but you don't want to overcomplicate your trading because most of us have many different trading strategies to see different things in the market. We don't overlap them. We use them completely separate, but we have different types of markets at different times. Like right now, we have a huge risk-off market with high volatility. So I would pull out my strategies and what indicators and oscillators and what patterns I use during this type of market. So the most popular forms of technical analysis are the simple moving averages, support and resistance trend lines, and momentum-based indicators. So what is an indicator? We keep referring to them. They're like MACD, RSI, stochastics. They're mathematical formulas. But you have to remember, indicators only indicate. So indicators are like interpreters. They interpret price action when you can't make heads or shoulders of it. So why use indicators? Indicators serve three broad functions: to alert, to confirm, and to predict. An indicator can act as an alert to study price action a little more closely. Indicators can be used to confirm other technical analysis tools. And according to some investors and traders, indicators can be used to predict the direction of future prices. So even though it may be obvious when indicators generate buy and sell signals, the signal should be taken in context with other technical analysis tools and price action. Many traders swear by indicators to help with their timing of their trades and to alert them of the trends. But even for an investor more focused on underlying fundamentals of companies, learning how these indicators work can provide added conviction on new or existing trades. So we have trend indicators, we have momentum indicators, we have volatility indicators, we have volume indicators, and all of these help us make decisions. Then we have oscillators. Oscillators are formulas that bounce back and forth between a known number. For instance, RSI will always come out between 0 and 100, and we trade it above the 70 range and below the 30. Okay. But there's lots of pros and cons. You have to decide what type of trader you want to be, what you're going to rely on, what works best for you. So technical analysis considers the market to be 80% psychological and 20% logical. Fundamental analysis considers the market to be 20% psychological and 80% logical. Psychological and logical may be open to debate, but there's no questioning the current price of an asset. After all, it's available for all to see and nobody can doubt its legitimacy. The price set by the market reflects the sum knowledge of all its participants. So the bottom line is, We want to know what is the price, where it has been, and where it is going. Okay. And with those three pieces of information, you can start making intelligent trading decisions. So thank you very much for joining us. Please subscribe to my YouTube channel while you're here watching, and look at our other webinars and videos and enjoy them at your leisure. Thank you very much for supporting us, and have a great trading day. Bye now.